Good morning, good afternoon, good evening, folks. Michael Zuber, One Rental at a Time. It is Sunday, and on Sunday, I get to be in your seats and learn some new information. My good friend Dan Bird is teaching me about technical analysis, what is going on in the stock market. As everyone should know on my channel, I lost $150,000 in the stock market because I was an emotional trader, and Dan is trying to help me be non-emotional. So Dan, how you doing today?
I'm doing very well. I only thought it was 100,000.
Oh, 150 grand, man. 190 down to 40. That's $1.50 all day long. Yeah. So yeah, pretty painful stuff. Again, I was an emotional trader, and what you've been doing with me for a while now is really trying to take emotions out, which again, I'm still learning. So I thought what we would do in this episode is we'd go back to our very first video, which is actually in your playlist called, I think it's just called Dan and Stock Trading. So people can go back and watch it. And then we're going to connect that first video with what we looked at with what is going on today. And I think it's pretty interesting. So
yeah, it's been about 3 months.
Yep.
So we can kind of update what we looked at the first time and see where it's come since then.
Yeah, I thought that'd be fun.
We talked about in that first one, the 3 levels of stock market traders. There's the gamblers, right? That just throw all their money out there. They think they know which way a stock is going, so they throw everything at it.
Stop calling me a gambler. I'm just kidding.
You're not anymore.
No, not anymore. No, I refuse to play until you help me.
Right. Second level is a trader, which is someone who will move in and out of the market and trade on it could be a day trader, but I prefer, in my case, it's more of a weekly to a monthly.
Yeah, short term nonetheless.
Swing trading, trend trading, that type of thing. And the third one is an investor.
Right.
Who identifies good fundamentals, good company, good management, basically a Warren Buffett type of person.
Yeah, and
invests in it, and just stays with it, throughout the whole their investing.
Yeah, what I really
hold it forever, basically.
Yeah, what I want to talk about, what's most important for people watching this is don't miscategorize yourself. That's where you get in trouble. If you're a gambler, own it. There's plenty of people that do it and make money, but own it. I made the mistake of calling myself an investor, and where in reality, I was probably truly an investor for the first year because I was doing the work, reading the P&Ls and making informed decisions. But I got cocky. I stopped the daily discipline and I jumped right to a speculator or a gambler. So again, there's nothing wrong with the speculator, the trader, or the investor. Just don't miscategorize yourself, please.
Yeah, know where you are on that spectrum and know what the differences are between them. To be a gambler, you have to be very nimble. You have to, and regardless of what level you're at, you should always get out before you take a big loss.
Yeah,
it's okay to take a small loss. Yeah, and everybody will take a small loss. That's just part of the game. You have to understand you can't continue to take big losses because your portfolio will go down by 150,000.
Yeah, 80% one. Yeah, not good, not good. But let's remind folks what we looked at again. They can go back to the playlist and see it for themselves. But let's kind of remind ourselves 3 months ago, a lot has transpired in 3 months, right? Fed started raising rates. We've got inflation raging. Yeah, we probably had the market rolled over. I mean, there's a lot that happened in the last 90 days.
Yeah, this is a little more of my newsletter that I put out every weekend, basically. This is an excerpt from this weekend. This is the yield inversion that we're going to talk about today, and a couple of cartoons that I put in. But if anybody would like to receive it, it's just send me an email at breakpointtrading@gmail.com. It's free, and I'd be happy to add you to it if you want. And if you get tired of getting it, or you don't think the cartoons are funny anymore, and just let me know, and I'd be happy to take you off.
Let me just say, you want to get it for the cartoons. It's again, I don't always have time, in fairness, to read it because you put so much stuff in there, but I always look at the cartoons.
Yeah, they're right in the beginning, so it's makes it really.
There you go.
So in review, I want to make sure we review this one here. This is a really important chart. I've talked about it before, but sometimes we forget, especially when the market's going down. But we are in a secular bull market. You can see this, the secular bears and secular bulls. Secular means it's long term. It will go for years. Cyclical bull or bear means that it will go down if it's a bear or up if it's a bull, but it's short term. Okay. So you can see inside of this secular bear market over here, there were 2 cyclical bull markets. inside of that. And inside of these secular bull markets, there are times when it goes down. This is the 1987 crash right in here.
Yep.
Right. And then the COVID crash right here.
Mhm.
And we've had a very brief cyclical bear market recently, at least on the NASDAQ and the Russell. The S&P never made it to bear territory. But the important thing about this that we should always keep in mind is that we are in a secular bull market.
Okay.
They typically run 18 to 20 years, and this one started in 2013. So we have until 2030, 2032, roughly in that neighborhood. You never know exactly, but somewhere in that neighborhood. But we've got a good 8 years left in the secular bull market.
Yeah. So that's really your thesis for all the investing you do is.
That's right.
Okay. All right.
Yeah. What that means is we will have cyclical bears. We just, had one and we might be coming out of it now. And we probably will have a recession. We'll talk about that when we talk about the inverted yield curve.
Oh, I want to come out and tell you right now, I'm very confident we'll have a recession in 2023, but
I think it will be a short one.
Okay.
Because we're in the secular bull market.
Okay.
All right. But important to keep that in mind where we are in the cycle.
All right.
So this one here is the chart that I showed 3 months ago. This is the yield, 10-year and 2-year. This one also has a 3-month and 1 month and 1 year included in it down here. These different colored ones down at the bottom. But the 10 and the 2 are the ones that most folks look at.
Yep.
Especially for inversions. You can see back here, there was an inversion in 2019. And then we had a recession in 2020. It was a short one. This is what it looked like in December, 3 months ago. Okay. What does this look like today? And remember, 3 months ago, I showed that the 2-year is accelerating faster than the 10-year. And even though the 10-year is going up, the 2-year is likely going to catch it.
Yeah, I remember having a discussion. This was December 29th. This is when the chart was from. And it's hard to believe that they were 30 basis. Well, actually, they were 40 basis points apart.
Yes, that's right.
Okay.
So what does it look like now? 3 months later. There's what it looks like. So right here, 2022, this is basically what that last chart showed.
Right.
Between this wedge right here.
Yep.
And I said the 2-year was starting to accelerate.
Man, it took off.
Well, in just 3 months, it has not only overtaken the 10-year, but we just had an inversion on Friday.
Yeah, and that's generally a sign that something is not right with the economy.
Yeah, the yield inversion is a pretty reliable indicator of a recession that's coming. It's been very reliable for years.
Yeah, since 1955. Yep.
Right. So that's what it looks like today. So in just 3 months, the 2-year has accelerated, overtaking the 10-year, actually surpassed it now as of Friday.
Yeah.
Now the way that
it's amazing to see that the 2-year went from roughly 1.2 to it basically doubled.
Yes. Well, more than doubled.
Wow,
back amazing. Here in the end of December, it was at 1.
Wow, that's amazing.
Right here. And it's at almost 2.5 now.
Damn. Okay. Now we know why mortgage rates are so high.
Yeah, mortgage rates are higher. They have been much higher in the past.
Of course, yes.
So I would say we're normalizing right now.
I think that's fair. I think the Fed stayed too low for too long.
Right.
No, I mean, these are just pure speculation. What do you think a normal 30-year mortgage is?
I think a normal is probably around 4%, 4 to 5.
Yeah, I would have I'd probably pegged 5.5. But
yeah, maybe 5.5, somewhere in that range.
Somewhere in there, yeah. Okay.
Now,
just curious.
Markets typically overshoot.
Yes, of course.
Right.
Both ways.
Even though we're normalizing and we're getting close to normal now, most likely we'll overshoot that and get much higher before it starts coming down.
Totally agree.
So you can also see on this chart gold. And I said back in December, which is, remember right here, this line right here, gold was still coming down. This gold line right here. I said gold is not indicating yet that inflation is an issue.
I remember.
But look at what has happened to gold since then, the last 3 months.
Yeah.
Not all the way up to here. The other thing I said was bonds should be in an inversion of the yield.
Right. They go the other way. Yeah.
So bonds should be going down if the yield is going up. Remember, this is January right here.
Mhm.
I said bonds are still trending down, even though yields are starting to go up.
Mhm.
But look what's happened since then.
Yeah. They just rolled over.
Bonds have just
They
fallen
cried
off the
uncle.
right.
Yeah.
So in the last 3 months, everything is just basically looks the way it's supposed to look when you have this kind of yield move.
Mhm. Agreed.
Now, the way that the yield curve normally is presented is the 10-year minus the 2-year. I'm showing the 10 and the 2 side by side in this case.
Mhm.
So this is how you can actually see the acceleration of both of them
Mhm.
and see which one is moving up faster. In this case, clearly the 2-year was moving faster than the 10,
Yeah. Clearly.
right?
Mhm.
But the way it's normally shown is like this. The red in this chart is the 10-year minus the 2-year.
Mm.
Okay.
Yeah.
And
correct.
that's when they typically, that's why they say a yield curve means it's gone below 0.
Yeah. 10 and 2. Right. 10 minus 2s. Yeah. When it goes below
Right.
0. Yep. Yep. Yep.
Right. And in this particular case, you can see the last 2 times it happened very briefly in 2019. 6 months later, we had a recession.
Mhm.
All right, August 2019, we had a very brief conversion.
Yeah,
Biggest
and
convert-
just so people can realize what I was doing with my real estate portfolio back in 19, I actually sold 2 apartment buildings because I envisioned a recession coming and I didn't want to own the C class apartments that needed work or value add. So I
Yeah.
thought I was selling at the top. And oh, lo and behold, we had the recession, the pandemic, and money got cheaper. So I left probably $500,000 on the line, but I couldn't predict a pandemic. So where the Fed would come out and lower rates to 0 for 2 years. But
Yeah, and
I looked at this and sold because of it.
yeah, and that's a good point. You can't predict anything
No, of course
in
not.
the markets. It's never bad to take a profit if you have a profit.
Mhm.
I was listening to John Carter, who is someone I really respect. He's a trader, and I've learned a lot from him, including how to do credit spreads.
Mhm.
And he had a comment that I thought was very appropriate. He said, if you're a trader, remember the 3 levels: gambler, trader, investor.
Mhm.
If you're a trader, your whole job, the reason you do what you do is to have the curve of your portfolio going up from bottom left to upper right.
Mm.
That is all your job is. Your job is not to be right. Your job is not to be smarter than the next guy. Your job is not to catch something at the absolute bottom. Your job is to make sure your portfolio balances are moving up consistently.
Yeah, growing. Yep. Okay. I like that.
That's all you should be doing. Now, if we look at the yield curve back in 2006, 2007, now the one in 2019 didn't stay there long. You see that.
No, it
And
didn't.
you can see we just on Friday, in fact, we just had a yield curve.
Mhm.
There's no way to tell how long it's going to stay there.
Mm-mm.
So just because we had the yield curve inverted doesn't mean a recession is 6 months out.
Mm-mm.
If you look at the one in 2006, the yield curve inverted in 2006. We didn't get the recession until 2008.
Hmm.
It took 2 years from the time the first conversion happened
Yeah.
until the actual recession happened. So I think a better way to look at this is to try to identify when it comes out of the yield curve,
Hmm.
when the yield curve stops being inverted. And
Okay.
it came out right here briefly, but it came out here in March of 2007, went briefly back below, and then came out again in June 2007. And between those 2 dates right there was 6 to 9 months till the recession.
Got it. Okay.
So that's a cautionary comment.
Mhm.
Everyone likes to talk about the inverted yield curve. You'll see it on the news and CNBC
Yeah.
and everywhere else.
Yeah. I think that's one of those things that people throw out there to sound intelligent, but it's not a great predictor of a timeline, right? People like to say, hey, we just inverted, recession is 6 months away. Not
Right.
necessarily.
That's right.
It's 6 to 24 months. A recession is.
That's
happens.
right. And the research that you mentioned that you did, showing that the yield curve inversion has been reliable back to 1955.
Mhm.
That is true. But all of those never say 6 to 9 months later, there's a
No,
recession.
it does not. Not at
They
all.
just say that there is a recession.
Yeah. Yeah. The
Right.
other thing that we need to realize is this one thing that, again, I look at the cost of capital. And one of the things that we have coming is on May 3rd and 4th is another Fed meeting. I believe they're going to finally have some balls and raise rates 50 basis points. I believe some of this front end curve, the 2-year included, is moving up before that, right? It's moving up early. What I don't think the market is ready for is I think the Fed is going to be aggressive in reducing their balance sheet, which actually will impact the back end of the curve.
Yeah.
We have not had that happen. We have not had a Fed with $9 trillion in balance sheet that needs to be reduced. I do not think anyone is of yet appreciating. We could have the yield curve not invert come middle of May, because what happens to the Fed is when the Fed sells bonds, the price will go down and the rate will go up right there. And I think we really could have the long end shoot up if the Fed gets aggressive and unloads, which would change the yield curve seemingly almost overnight.
Yeah, that's a really good point, actually. It'll be interesting to see what happens. 2 other dates I'll throw out there is next Wednesday will be the Fed minutes from the
Yes,
last meeting.
I'm looking forward to that. I talked about that on my daily financial news this morning. I want to know how many Fed presidents were talking 50 basis points and got talked out, because Bullard was the only dissent. And I can't believe he was the only hawk in that meeting.
Right. Yep, I agree. That's going to be very interesting to see what happens. I mean, that could give a pretty clear indication of what's going to happen on May 3rd. I think everyone's expecting a half point.
Oh, it has to happen. We've had 8. So one thing that I've learned about Powell, because again, I've been watching Fed presidents for 30 years, is he is following Ben Bernanke's script. He is clearly articulating weeks and months in advance what's coming, because he doesn't want to surprise Wall Street.
Right.
And we've had 8 Fed presidents in 6 business days talk about 50 basis points coming. It is happening.
Right.
It is absolutely happening. Paul Volcker was of a different ilk. He was like, I'm going to surprise the Fed. I'm going to do stuff on the weekends because I don't want the Wall Street to know what's coming. Powell is yet to go that way. He's clearly telling him. So 50 basis points is coming. And I would argue that 50 basis coming in May and June. So we'll see.
Yeah, we'll see about that. We've had this discussion before when the rate of change of inflation is going to be apparent. And I think it's going to be apparent in June.
Okay. We shall see.
Maybe July. I think you think it's late, farther out.
Yeah, I think it's August and September, but yeah.
But if the rate of change is apparent in June, they might still go with a quarter of a point.
Yeah, I really don't think so. I think they're going to go a half, because I think they want to point at that saying, see, we did it. We took action and inflation's coming down because of what we did, where you and I know it's the rate of change would have changed anyway, but we'll see.
Yeah, but you know, as you mentioned, and I think you're right, the reduction of their balance sheet might actually have a bigger effect than the rate change.
I mean, we've already seen, I reported this morning, $45 billion in deals not being done. That's IPOs, bond raises, acquisitions being delayed because cost of capital. The Fed starts affecting the back end of the curve like they've never done before. Folks, again, the Federal Reserve only controls, typically speaking, the very, very front end overnight rates. What they're going to do when they sell off their portfolio is they're going to have dramatic impacts on the back end. This has not happened before. It is going to be something to watch.
Yep. Should be interesting. The second date to keep in mind is April 12th.
What's that?
Which is the CPI number.
Oh, yeah. All right, let's play over under. So CPI last month was 7.9. We obviously had lots of oil and gas issues that are going to be in this number. Rent is starting to come through. I'm going to say 8.6. Were you going to take the over or the under?
I will take the over on 8.6.
I think so too.
If you had said 10, I would have taken the under.
So 9.9, you're taking the over at 9.9?
No, I think it's going to be right around 9.
Yeah, I think 8.6. Folks, if you want to play along with Dan and I, here's the number, 8.6. It'll be reported on April 12th. Just leave a comment below, over or under. And if you feel really fun, pick a number. Let's see what happens.
Yeah, on the spreadsheet that I created to track the 12-month rolling number of CPI
Mhm.
or inflation.
Mhm.
You remember that?
I
I
do.
kind of calculated, I estimated what it was going to be by the end of the year.
Mhm.
I calculated 6.6, and then a lot of that's front end loaded.
Yeah.
And that would mean you would see the rate of change declining
Decelerate. Yeah.
by June, which is why I said that.
Yeah.
But I had 9% on this next one.
Okay.
So
Yeah, it's
we'll see.
it's going to be interesting. Any other closing thoughts on this? Again, folks, yield inversion is a thing. It is something to understand. I think a better thing to understand is the Fed has to reduce their balance sheet. Nobody's talking about that. That will directly impact the back end, not the front end. So be careful.
The only other thing is the state of the market this week.
Sounds good.
We talk, every week we look at where we're at, and we've had this big, huge rally from the 14th. It broke through the reversion to the mean, which is the center line here.
Yep.
And just continued on up, and it got all the way up. I mean, last time we talked, I said it probably will get to 3x, which is this light gray area at the top. But it typically doesn't stay there very long.
Yeah.
Made it up into 4x way back here and just touched 3x in through here. Well, it hit 3x and started coming back down.
Okay.
Right on cue, essentially.
Yeah.
So now we're trending back towards the center line again, the reversion to the mean. Although we had a pretty strong close on Friday. You can see here this little candle. The left-hand notch is where it opened and the right-hand notch is where it closed. So even though it dropped down a lot during the day, which made it feel like
it
was going down a lot, it came down right at the close. I mean, it came back up right at the close. So that's pretty strong. I think we still have some upside left.
And it looks like the street is accumulating. Is that how I read that? The one below?
Yes, the street is accumulating big time.
Yeah.
All the way from back here from the 14th, where it went below the moving average. And ever since then, the street, the big institutions are accumulating big time. So this little bear market we had may very well be over. Now, it wouldn't surprise me to come back down and test this again. That's normally what markets like to do. Although it did kind of test it here. So it hit down here in February, the low. Went back up to reversion to the mean, back to the middle, and came back down and tested it. Didn't quite hit the low, hit a little above the low, so made a higher low. So it kind of tested it once there. It wouldn't surprise me to see it come back down and test it again, but it looks pretty strong to me, actually.
Yeah.
So we may actually be out of the woods.
Yeah.
And
This is why technical trading and my kind of econ background kind of diverge, because I see earnings announcements coming, right? We just finished Q1. Earnings announcements really start a week from Monday in earnest with the big banks and then retailers. I just can't imagine how any of those institutions are going to have earnings that are expanded. I see multiples contracting, not expanding in a raising rate environment. So this is why I'm learning new things. It doesn't feel like we're heading into a very bullish environment.
Yeah, but keep in mind, the market is always ahead
of
the economy. All right. Always remember that. The market's always ahead of the economy.
Okay.
And that very well may be the case. I think that what's happening in Ukraine is going to affect a lot of multinational companies.
Oh, no question. Europe has to go into a recession. Yeah.
I mean, it may be a small part of their overall revenue, but it is a part.
It's meaningful, right? You and I both know we had quota for Europe for a long time. It was, I don't know, 18 to 23%, depending on the company in the quarter. That's, you lose half that, that's 9 points.
Well, and you could lose it all.
You could lose it all. Exactly.
You could lose it all. I mean, McDonald's and Burger King are pulling out completely.
Yeah, exactly.
So, but that didn't happen until the end of February, and really they didn't really start pulling out until mid-March or third week of March. So it may not be reflected in Q1.
But no, hold on. Well, it won't be in the actuals, but it'll be in the forecast, right?
It'll be in the forecast.
Right. A lot of companies will say, and that's what happened in Q4, right? We hit Q4, retail sales were great, but the future looks dark. And stock prices are typically a presentation of future earnings, not past.
That's right. Yeah. And that's going to be the key, when we go into earnings season, it's not going to be so much whether they beat or met
No,
or
it'll
miss
be
the number. It's going to
mean
be what
almost
is your
nothing.
projection for the rest of the year.
And
And I agree with you. I
that's,
think multiples are going to start coming down and projections are going to start coming down, and that's going to affect the stock prices.
that's where my head's at right now. Yeah. So,
However,
Mhm.
earnings aren't really going to start until in earnest until
Mhm.
probably the third week of April.
yeah, big banks I think are like the 12th and 13th, but yeah, the
Right.
big week will be the 20th or something. Yeah, that week.
Right. And we'll have the Fed meeting next Wednesday,
The Fed minutes.
but Fed minutes, but I think it's already built in.
Yeah, I think so.
And then we'll have the CPI number on the 12th,
Mhm.
which I think is already built in.
Okay.
I think the market has the potential to rise over the next
10 days.
2 weeks.
Two,
Let's
okay.
call it 2 weeks.
Okay. All right.
So we may get up, last week when we talked about this,
Mhm.
let's see, last week we were down here around 40, we were under 4,500, I think,
Okay.
down this area. And I said last week, it looks like it still has more juice. I think
You
it could make
you
it
did.
46.
You did. Yeah.
And it did. It made it a little
Yeah.
above
And this
46.
is why being a trader, right? Going back to the very beginning of this conversation, are you a speculator, a trader, or an investor? Traders could be looking to make moves in 10 days,
Right.
where an investor's like, I'm going to wait for the earnings, right?
Yeah, an investor wants to buy a good company with good management
Yeah.
and a good stock. When it declines, it comes back down.
Yep.
But they can buy it cheaper.
Yep.
That's what investors will look at.
Mhm.
But traders don't really care. We don't care if the
No.
market's going up or down. I'm going to talk about this in the next session when we'll talk about credit spreads.
Very cool.
But it's really important to understand technical analysis so that you
Mhm.
can see where the ranges are. What's the potential range in the next week and a half, 2 weeks?
Very cool. Well, this is a lot of fun. I'm glad we're doing this every week. You definitely are teaching me new things. Can you bring up your email one more time if somebody wants to get on the news list,
Sure.
which
Yeah.
I am a part of or I'm on? breakpointtrading@gmail.com, just in case you are listening on the podcast. breakpointtrading@gmail.com. Thank you very much.
All right, you bet.